In this video, we are going to be analyzing the Grand Rapids rental market for multifamily properties. So welcome back. I hope Indianapolis was a fun one for you yesterday. If I scroll out a little bit, you can see that the Grand Rapids, Michigan area is not too far from Indianapolis. You can see we have Milwaukee, which we did last week. We have Detroit, Cleveland, Columbus, Ohio, which is coming up soon. Here's Fort Wayne, Indiana, Chicago, Illinois, Lake Michigan, and of course, the U.S.-Canadian border. So let's scroll back in and let's take a look at our filters. So when we look at what we're excluding, as usual, we are excluding the all corporate, all military, all senior, and excluding all vacation. We are only including market and market affordable, so we are only looking at conventional apartments. If we go to location, we can see that we are in market, metro statistical area, Grand Rapids, Michigan. So let's go take a look and see what the analytics tells us for all three asset classes, Class A, Class B, and Class C. So here is our supply snapshot for Grand Rapids, Michigan metro statistical area. You can see that there are only 723 properties in this market, totaling 60,377 units. There is still 1,596 under construction, and 767 have absorbed in the last 12 months. So 767 more renters entered the market. The year prior, in 2021, 1,840 renters entered the market. The vacancy was at 3.1% a year ago and is sitting at 4.5% today. Tells me we are definitely seeing a slowdown in the absorption. Probably see a little bit of negative absorption in order to get this increasing vacancy rate, but we will take a look. Year over year, we're still positive rent growth. We'll see what it looks like on a quarterly basis. And as usual, we will not look at the capital markets. Coming down to our long-term occupancy average, over the last 22 years, the Grand Rapids, Michigan market likes to sit at about 94.5, so 94.62%, and it's currently at 95.5, so 95.49, slightly above that long-term occupancy average. So another market that we're probably looking at in the oversupply phase, but let's go take a look and see what the data shows us. So here is the rental analytic data for the Grand Rapids, Michigan metro statistical area. We will be not looking at asking rents because we don't care what the ownership or management is asking for rents. We only care what they are collecting, and so we will only be looking at effective rent. First quarter 2022, it was at $1,209, went up to $1,262, slightly down to $1,259, and then down to $1,238. So 2 straight quarters of downtrending rents. Let's see what the deliveries and absorption tells us. So we can see that there was 76 units delivered in the first quarter and 181 absorbed. So a little more than double absorbed than delivered. That's good. Then we had 534 delivered, but only 417 absorbed. So we've got a slowdown in absorption. Another 337 delivered, only 195 absorbed. Another 123 delivered, only 6 absorbed. So we are definitely seeing that slowdown, albeit no negative absorption in the overall. So this is actually a fairly decent sign that this is happening slowly in the Grand Rapids, Michigan area, kind of like we saw with Milwaukee. So not too surprising that we're seeing this. And we can see that downtrend in occupancy because of the slowdown of the absorption, but not too terribly bad, but it is trending in that direction. Keeping in mind, we are still slightly above that long-term occupancy average. So let's go see what the Class A market is telling us. Here is the Class A rent analytics. There are 41 properties totaling 5,770 units. Looking at effective rent, they started at $1,566 in the First quarter of 2022 went up to 1634, went up to 1660, and then down to 1630. So went down lower in the fourth quarter than they were in the second quarter, but still above where they were in the first quarter. So we are now starting to see that downtrend in the Class A market, albeit just starting in the fourth quarter. Let's see what deliveries and absorption tells us. So when we look, we had no deliveries in the first or fourth quarter, and we had some deliveries in the second and third quarter, albeit a small amount. So it looks like the majority of our deliveries are happening in the B space, much like we saw with Indianapolis. So even though we had no deliveries, we still had 80 units absorbed, so 80 more people moved into the market than moved out. Then we had 138 deliver and only 58 absorb. So really, they're canceling each other out. We have 138 and 138. So by the time we got to the third quarter, we ended up at equilibrium, but we could see that another 114 units delivered and 165 absorbed. So a nice absorption number. So we are in positive absorption from deliveries. No deliveries in the fourth quarter with another 6 absorbing. So we have more absorbing than delivered in this market. And we had a downtrend in rents, which is fairly interesting. Now we had that downturn from first quarter to second quarter because we had that slowdown in the deliveries to absorption here. And then that occupancy started to tick back up again, although it did not catch up to where it was, even though there was more positive absorption. So a little interesting tale there, but it is responding appropriately to our deliveries and absorption. So it's interesting that the rents declined as much as they did in the fourth quarter, considering positive absorption, but interesting tale. So let's see what the Class B space is telling us. Here is our Class B rent analytic data. There is 191 total properties totaling 21,899 units. Looking at effective rent, they started at $1,254 in the first quarter, went up to $1,306, very slightly down to $1,305. You can really say that it was stabilized between second and third quarter, and then down to $1,280. So we are starting to see that downtrend now happen with the Bs. So let's see what deliveries and absorption tells us. So we do have the majority of the deliveries happening in the Bs, just like we did in Indianapolis. We had 76 units deliver in the first quarter and 79 absorb. 126 deliver in the second, 143 absorb. So absorption is keeping up with deliveries. 223 delivered in third, 144 absorbed, so a little slowdown there. But then it picked right back up again, 123 delivered and absorbed just about all 123. So not surprising that we went from 96.2 in the first quarter to 96.0 in the second quarter, because we did have some slight slowdown, like really slight, but for the most part kept up. So this shows a sign of a pretty stable rental market for Class B space in Grand Rapids, Michigan. So tells a pretty interesting tale that Class Bs are kind of holding strong right now. So we'll see if it will continue that way going into 2023. But right now, Class Bs are holding strong in this market. No real sign of downtrend yet. And again, we're not looking at first quarter 2023 because that data is just too young and it is probably erroneous. So kind of like what I see with Grand Rapids, Michigan at this point for the Class B space. Looks like the darling so far. Let's see if the C's can top it. Here is our Class C rent analytic data for the Grand Rapids, Michigan metro statistical area. There are 462 properties totaling 32,094 units. Looking at effective rent, we started at $1,094 in the first quarter, went up to $1,145, and interesting that we're seeing a downtrend from $1,135 and then to $1,119. So lower rents in the fourth quarter than we saw in the second quarter. So it looks like that the Class C is what's dragging this market down. This is only the second time, I believe, we've seen the Class C market follow a 2 straight quarter downtrend in rents. Let's look at absorption and see if we can see why that is. So, as suspected, we are kind of seeing some downtrend here, but honestly, not too bad. Ignore the deliveries, ignore the under construction, because that's erroneous information. You don't deliver Class C properties to a market. They're probably Class C or C- neighborhoods, and so they're given a Class C classification by CoStar, even though they will be delivered as Bs. So when we look at this, pretty much what do you got there? 236 and 238. So only an absorption of 2 units for the entire year. So we've got from 97.6 to 96.7 in occupancy. Not too terrible of a drop. So I'm a little surprised to see the Class C rents declining as much as they are. Interesting tale there that this Class C market may be a little bit volatile. But looking at Grand Rapids, Michigan overall, we kind of like the Class B space here. A's aren't reacting too terribly bad. C's seem to be reacting the most negative in the market, which is an anomaly because most markets we see, the Class C's are the most positive. So we like the B's in this market, not necessarily the C's. And of course, I never like the A's, but that's just, a risk-reward type thing. In any case, I think we're pretty much confirmed here that this market is in the oversupply phase, probably about midway in the oversupply phase, because we have a really shallow vacancy rate in this market on a long-term average anyway. If you remember, that long-term occupancy average sits right around that 94.5%, and it's currently sitting at 95.5% overall. So we'll put them about mid-range between equilibrium and long-term occupancy average. But in the Class A and Class C space, they are definitely trending negatively towards that long-term occupancy average. So it's pulling those Bs down, even though the Bs seem like that they are holding strong through this market. But we will probably see a change moving forward. So that does it for Grand Rapids, Michigan. Stay tuned tomorrow for Omaha, Nebraska.